Walk into any Australian suburb and you will see the same names dominating every shopping centre. Woolworths, Coles, Aldi. The big chains are everywhere, squeezing out local grocers, controlling prices, and building an empire that gets stronger every single year. But here's what shocks most Australians. These 5 massive chains now control over 80% of the entire grocery market. That means when you shop for food, you have almost no real choice. The Australian Competition and Consumer Commission just released a damning report that confirms what many suspected. The supermarket sector has become an oligopoly where a handful of giants have crushed competition, squeezed suppliers, and built what might be the most profitable supermarket operations in the entire world. The number 2 revelation will shock you about just how much power these chains actually have. We're about to reveal the 5 supermarket chains that have taken over Australia in 2026, how they got so powerful, where they really come from, and why independent grocers are disappearing faster than ever. This goes beyond simple business competition. This is about market dominance, supplier exploitation, and the slow death of choice in Australian grocery shopping. Number 5. Metcash and the IGA network. Let's start with the one most Australians think is the underdog, IGA, supplied by Australian company Metcash. You see IGA stores in suburbs, regional towns, and remote communities across Australia. They feel local, independent, and different from the big chains. And technically, they are independent because each IGA store is individually owned by local operators. But here's the reality, Metcash controls the entire supply chain for over 1,400 IGA stores, plus Foodland stores in South Australia, and dozens of other independent grocers. While each store is independently owned, they all depend completely on Metcash for inventory, pricing structures, and operational support. This creates a network that, while technically independent, operates as a unified chain competing against Woolworths and Coles. Metcash is a 100% Australian company, founded in the 1920s, that has survived by consolidating independent grocers into a collective buying network. The company generates billions in revenue annually by acting as the wholesaler and distributor for these independent stores. But IGA faces brutal reality in 2026. The network holds only 7% of the national grocery market. This tiny market share makes survival increasingly difficult. According to the ACCC inquiry, IGA stores typically face higher operating costs than the major chains, struggle to compete on price, and lose customers to better located Woolworths and Coles stores. Many IGA stores operate in regional and remote areas where Woolworths and Coles have chosen not to build. This gives IGA crucial importance for communities that would otherwise have no grocery access at all. But profitability remains challenging, particularly as the big chains continue expanding into previously underserved areas. The independent grocers face another devastating problem, land access. When suitable retail sites become available, Coles and Woolworths can outbid IGA operators easily because the major chains have massive financial resources. The ACCC found that Woolworths and Coles hold significant numbers of undeveloped sites, essentially land banking to prevent competitors from establishing stores in strategic locations. For suppliers, IGA stores offer an alternative to the duopoly of Woolworths and Coles. Many smaller producers find IGA more willing to stock local products and provide shelf space that the major chains deny. But the volume remains small compared to what suppliers can achieve through Woolworths or Coles. Metcash has fought hard to strengthen the IGA network through better logistics, private label products under the IGA brand, and localized product assortments. But the fundamental challenge remains, competing against chains with more stores, better locations, lower costs, and stronger bargaining power with suppliers becomes harder every year. We're independent Australian news covering what mainstream outlets won't. Join our channel to help us continue. Number 4. Aldi, the German discount invader. Aldi is not Australian. This is a German discount supermarket chain that entered Australia in 2001 and has systematically expanded across the eastern states with ruthless efficiency. The company is privately owned by the Albrecht family in Germany and operates with a business model perfected in Europe: limited product range, high turnover, low prices, and minimal staff. In 2026, Aldi controls approximately 9% of the Australian grocery market with over 570 stores concentrated in Queensland, New South Wales, Victoria, South Australia, and the Australian Capital Territory. The chain has no presence in Western Australia, Northern Territory, or Tasmania, focusing instead on densely populated areas where high-volume sales justify operations. The story of how Aldi entered Australia reveals calculated strategy and patient execution. The German giant studied the Australian market for years before opening its first store in Sydney in 2001. The company identified the Woolworths-Coles duopoly as vulnerable to discount competition and methodically built a network of stores designed to undercut the established players on price. Aldi's impact on Australian grocery shopping cannot be overstated. The chain forced Woolworths and Coles to lower prices on hundreds of products simply by existing as a discount alternative. Before Aldi arrived, the duopoly had little incentive to compete aggressively on price. Aldi changed that calculation overnight by offering comparable products at prices 15 to 20% lower than the major chains. The business model is brutally simple and effective. Aldi stocks only around 1,800 products compared to 25,000 plus at Woolworths or Coles. This limited range means higher volume per product, better negotiating power with suppliers, and lower inventory costs. Most products are Aldi's own brands, manufactured specifically for the chain, which eliminates expensive national brand premiums. Walk into any Aldi store and you will see the efficiency obsession immediately. Products remain in shipping boxes stacked on pallets rather than being individually displayed on shelves. Staff work multiple roles, operating checkouts, restocking shelves, and managing the store with minimal personnel. Checkout speed gets optimized relentlessly, with cashiers scanning items faster than any other Australian supermarket. The entire operation focuses on keeping costs low so prices can stay low. Aldi stores are smaller than traditional supermarkets, reducing rent and utility costs. The limited product range means less inventory management and simpler logistics. The no-frills approach extends to every aspect of the business: basic store design, minimal advertising, limited customer service, and streamlined operations. According to the ACCC, Aldi's prices average 15 to 20% lower than Woolworths and Coles on comparable products. This price difference is substantial enough to attract price-conscious shoppers but achieved through operational efficiency rather than accepting lower profit margin. In fact, Aldi's profitability per store often matches or exceeds that of Woolworths and Coles despite lower prices. But Aldi faces significant limitations that prevent it from seriously challenging the duopoly. The limited product range means many shoppers use Aldi for staples but still visit Woolworths or Coles for specialty items, fresh produce variety, and national brands. Aldi also refuses to accept credit cards at checkout, requires customers to bring their own bags or purchase them, and offers minimal customer service compared to full-service supermarkets. The geographic concentration presents another limitation. Aldi has no presence in Western Australia, Northern Territory, or Tasmania, essentially ceding those markets to Woolworths and Coles. The company focuses on densely populated areas in the eastern states where high-volume sales justify the logistics of supplying stores. This geographic strategy makes sense for Aldi but leaves large portions of Australia completely unserved. The ACCC report notes that Aldi took over 20 years to reach 9% market share, which demonstrates how difficult challenging the established players truly is. Despite offering lower prices and steady expansion, Aldi has not fundamentally disrupted the market structure. Woolworths and Coles remain dominant, and Aldi seems stuck around 9 to 10% market share with limited ability to grow significantly further without changing its business model. The question becomes whether Aldi can break through to 15% or 20% market share, or whether the company has reached its natural ceiling in the Australian market. The evidence suggests Aldi faces structural limitations that prevent further significant growth. Many Australians have tried Aldi and decided the limited range and no-frills experience do not suit their needs. Converting these shoppers would require Aldi to become more like Woolworths and Coles, which would undermine the efficiency that enables low prices. Interestingly, the ACCC found that Aldi is among the most profitable supermarket operations globally when measuring EBIT margins. The discount positioning does not mean low profitability. Rather, Aldi's operational efficiency generates strong profits while maintaining low prices. This profitability comes from supplier pressure similar to what Woolworths and Coles apply, forcing manufacturers to accept thin margins to access Aldi's volume. Suppliers describe dealing with Aldi as difficult and demanding. The company negotiates aggressively on price, requires suppliers to meet strict quality standards, and offers limited flexibility on terms. For many suppliers, Aldi represents a necessary channel to reach price-conscious consumers, but the margins are thin and the relationship is purely transactional. For Australian consumers, Aldi provides a valuable alternative that forces some price discipline on the duopoly. When Aldi enters a suburb, nearby Woolworths and Coles stores typically lower prices on key products to remain competitive. This benefits all shoppers in the area, even those who never enter an Aldi store. But Aldi is a German-owned chain extracting profits from Australia and sending them overseas, just like any other foreign corporation. The Albrecht family, which owns Aldi globally, is among the wealthiest families in the world, with estimated wealth exceeding $50 billion. When Australians shop at Aldi, they contribute to this family's fortune rather than supporting Australian-owned businesses. The company contributes to market concentration rather than genuine competition because it operates with the same basic model as Woolworths and Coles: squeeze suppliers, minimize costs, maximize efficiency, extract profits. Aldi simply executes this model more efficiently in a no-frills format. The result is another large chain dominating the market rather than the diverse competitive landscape that would truly benefit consumers. Number 3. Costco and Amazon, the foreign online threat. Here's where the story gets interesting. Two foreign giants are slowly but steadily eating into traditional supermarket sales, and both are American companies, Costco and Amazon. Costco, the American warehouse club chain, operates 15 stores in Australia concentrated in major cities. The company entered Australia in 2009 and has grown steadily by offering bulk products at wholesale-style prices to members who pay annual fees. Costco is not a traditional supermarket, and its market share remains small, probably under 2% of total grocery sales. But the company represents a different model that appeals to specific customer segments, particularly families and small businesses buying in volume. What makes Costco significant is the membership model creates customer loyalty and predictable revenue. Members who pay $65 annually for the privilege of shopping at Costco tend to concentrate their spending there to maximize value from membership fees. This creates a dedicated customer base that traditional supermarkets struggle to win back. Amazon represents an even more significant threat, though still emerging in Australian grocery. Amazon Australia launched in 2017 and has grown rapidly, with grocery sales expected to reach $6.5 billion in 2025 according to Goldman Sachs estimates. That represents explosive growth and a genuine challenge to traditional retailers. Amazon operates differently from physical supermarkets. The company leverages vast distribution networks, sophisticated algorithms, and subscription services like Amazon Prime to make online grocery shopping convenient and competitive. Amazon's grocery offering includes both pantry staples and fresh food through partnerships with local suppliers. What makes Amazon dangerous for the traditional chains is the company's willingness to operate at low margins or even losses to gain market share. Amazon has virtually unlimited capital from its global operations and can sustain Australian grocery operations even if they lose money for years. This financial staying power terrifies Woolworths and Coles because it enables Amazon to undercut on price indefinitely while building customer habits. Both Costco and Amazon face limitations in the Australian market. Costco's warehouse model appeals to specific customers but will never achieve mass market penetration. Amazon's grocery delivery works well in urban areas but struggles in regional and remote Australia where population density cannot justify the logistics costs. Neither Costco nor Amazon threatens to break the Woolworths-Coles duopoly fundamentally, but both companies nibble at market share, force price competition in specific categories, and demonstrate that alternative models can succeed in Australia. Together, they probably control around 3 to 4% of total grocery spending currently, and that percentage is growing. The important point here is that both Costco and Amazon are American corporations extracting profits from Australian grocery spending and sending returns to American shareholders. Like ALDI, they represent foreign ownership of critical food distribution infrastructure. When Australians shop at Costco or order from Amazon, money flows overseas rather than staying in Australian hands. Major outlets ignore stories like this. We don't, but we can only keep investigating with your support. Join to help us stay independent. Number 2. Coles, the Australian giant building an empire. This one will shock you. Coles is the second largest supermarket chain in Australia with 29% of national grocery sales, operating over 800 stores from every state and territory. The company generates tens of billions in annual revenue and employs over 100,000 Australians. Most people think Coles is simply a big supermarket chain competing fairly against Woolworths. The reality is far darker. Coles is part of Wesfarmers, one of Australia's largest conglomerates, which provides enormous financial resources and competitive advantages. Coles can leverage Wesfarmers' scale, capital, and political influence to crush competitors and dominate suppliers in ways independent retailers cannot match. The company's history reveals systematic elimination of competition. Coles was founded in 1914 by George Coles in Melbourne as a general merchandise store. In the 1950s, the company shifted focus to groceries and began acquiring competitors aggressively. Throughout the 1960s, 1970s, and 1980s, Coles bought or drove out of business dozens of regional and local supermarket chains. Names that once meant something to Australian shoppers were systematically eliminated. Bilo, Newmart, Tuckerbag, and numerous others were either absorbed into Coles or forced to close. By the 2000s, Coles had consolidated into a duopoly with Woolworths, controlling the vast majority of Australian grocery sales. The ACCC's recent inquiry exposed the truly shocking extent of Coles' market power and profitability. When measuring EBIT, earnings before interest and tax, net profit after tax, and return on total capital together, Coles ranks among the most profitable supermarket operations in the entire world. Let that sink in. Coles is not just profitable for Australia, it is one of the most profitable grocery retailers globally. How does Coles achieve these extraordinary profits? Through ruthless exercise of market power at every level. The ACCC found that Coles squeezes suppliers by demanding wholesale prices be set so that Coles maintains or increases retail margin percentages even when costs rise. In plain language, when suppliers' costs increase, Coles forces them to set new wholesale prices that allow Coles to maintain the same profit margin percentage, which means Coles' profit dollars increase even though nothing about Coles' operations change. The ACCC described this as evidence that Coles exercises significant market power in retail markets. Suppliers have little choice but to accept these unfavorable terms because losing access to Coles' 800-plus stores would be catastrophic for their businesses. Many suppliers told the ACCC they receive prices below the cost of production but have no alternative except agreeing to highly unfavorable terms or going bankrupt. Coles also engages in what the ACCC called misleading pricing practices. The regulator launched separate legal proceedings alleging Coles engaged in misleading conduct through discount pricing claims on hundreds of products. The allegation is straightforward: Coles raised prices temporarily, then applied discounts that brought prices back to near where they were originally, allowing Coles to claim savings that were illusory. Beyond supplier pressure and misleading discounts, Coles uses its scale to acquire the best retail locations and prevent competitors from accessing prime sites. The ACCC found Coles holds numerous undeveloped sites, essentially land banking to block competitors. When excellent retail locations become available, Coles can outbid any independent grocer or smaller chain because Wesfarmers provides virtually unlimited capital. Coles also operates sophisticated loyalty programs like Flybuys that collect massive amounts of customer data. This data provides insights into shopping behaviors, price sensitivity, and purchasing patterns that Coles uses to optimize pricing and promotions. Smaller competitors cannot match this data advantage. The truly shocking part is that Coles' dominance is described by the ACCC as entrenched, with no realistic prospect of being broken. The barriers to entry for new supermarket competitors are so high, and Coles' advantages are so significant, that the duopoly with Woolworths will likely continue indefinitely. There is no silver bullet solution, according to the ACCC, meaning Australians are stuck with Coles' market power for the foreseeable future. Coles is an Australian company, founded and headquartered in Australia. But ownership sits with Wesfarmers, and profits flow to institutional shareholders, many of them foreign pension funds and investment firms. When Coles makes record profits by squeezing suppliers and charging Australians high prices, those profits get distributed globally rather than benefiting Australian communities where the stores operate. Number 1. Woolworths, the untouchable supermarket monopoly. And now, the most powerful player of all, Woolworths. This is Australia's largest supermarket chain, controlling 38% of national grocery sales through over 995 stores across every state and territory. Woolworths generates over $63 billion in annual revenue and employs over 115,000 people, making it the largest private sector employer in Australia. The company dominates Australian grocery retail to a degree that would be considered a legal monopoly in many other countries. Woolworths was founded in 1924 in Sydney, making it thoroughly Australian by origin. But the company has evolved into a corporate giant that exercises market power in ways that fundamentally harm Australian consumers, suppliers, and competition. The ACCC's final report makes this devastatingly clear. Let's start with profitability. When examining EBIT margins, net profit after tax, and return on total capital together, Woolworths ranks as one of the single most profitable supermarket operations in the entire world. Not just profitable for Australia. Not just successful by local standards. Woolworths' profitability rivals or exceeds any major supermarket chain globally, including in the United States, United Kingdom, and Europe. How is this possible? Through systematic exploitation of market dominance. Together with Coles, Woolworths controls 67% of Australian grocery sales. This concentration is far higher than comparable markets in other developed countries. The duopoly creates what economists call an oligopoly, where competition is limited and both players have incentives to maintain high prices rather than compete aggressively. The ACCC found that Woolworths and Coles offer remarkably similar experiences, undifferentiated product ranges, prices at similar levels, comparable loyalty programs, and limited genuine competition on price. When one chain raises prices, the other typically follows because both know aggressive price competition would reduce profits for everyone without significantly changing market share. This coordination does not require explicit agreement or collusion. It happens naturally in oligopolistic markets where participants recognize their mutual interest in maintaining high prices. The result is what the ACCC calls little incentive to beat one another on price, leaving Australian consumers paying more than they would in a genuinely competitive market. Woolworths' treatment of suppliers reveals even more shocking abuse of market power. The ACCC found that Woolworths has significant bargaining power imbalance with most suppliers and exercises that power through trading terms and business practices that are highly unfavorable to suppliers. Multiple suppliers told the ACCC they receive prices from Woolworths below their cost of production but have little choice but to agree, because losing access to Woolworths stores would destroy their businesses. Woolworths, like Coles, sometimes accepts wholesale price increases only if retail margin percentage is maintained or increased. This means when suppliers face higher costs and need to raise wholesale prices, Woolworths forces the supplier to raise prices enough that Woolworths can increase its retail price while maintaining or growing its profit margin percentage. In effect, Woolworths uses supplier cost increases as opportunities to increase its own profits rather than simply passing through increased costs. The ACCC described this practice as indicating Woolworths has and exercises a significant level of market power in retail markets. No competitive market would allow such behavior because suppliers would simply sell to other retailers. But with Woolworths controlling 38% of all grocery sales, suppliers have no viable alternative. They must accept Woolworths' terms or go bankrupt. Woolworths also engages in misleading pricing practices that the ACCC is challenging in court. The allegations are straightforward. Woolworths temporarily increased prices on hundreds of products, then applied discounts that brought prices back to near original levels, creating the illusion of savings where none existed. This deceives consumers into thinking they are getting good value through promotions when in reality they are simply paying normal prices disguised as discounts. The land banking issue applies to Woolworths as well. The ACCC found Woolworths hold substantial numbers of undeveloped sites intended for future supermarkets. This land banking serves multiple purposes. It prevents competitors from accessing prime locations, it gives Woolworths options for future expansion, and it maintains Woolworths' dominant position by controlling access to the most valuable retail real estate. Woolworths' Everyday Rewards loyalty program collects enormous amounts of data on millions of Australian shoppers. This data reveals detailed purchasing behaviors, price sensitivities, and shopping patterns that Woolworths uses to optimize pricing strategies and target promotions. The data advantage is so significant that smaller competitors simply cannot match Woolworths' understanding of consumer behavior and market dynamics. Perhaps most troubling is the ACCC's conclusion that Woolworths' dominance is entrenched, with extremely high barriers preventing new competitors from entering the market at scale. ALDI took over 20 years to reach 9% market share, demonstrating how difficult challenging the established players truly is. The ACCC found no realistic prospect that Woolworths' market position will be eroded through normal competitive forces. The implications are profound and disturbing. Woolworths has built a market position that appears effectively permanent, exercises that position to maximize profits at the expense of consumers and suppliers, and faces no realistic competitive threat that would force change. The company is too big to challenge, too profitable to disrupt, and too entrenched to dislodge. Woolworths is headquartered in Australia and originated as an Australian company, but the company is publicly traded on the ASX, meaning ownership is distributed among shareholders globally. Major institutional investors include large foreign pension funds and investment firms. When Woolworths makes record profits by squeezing Australian suppliers and charging Australian consumers elevated prices, significant portions of those profits flow to foreign shareholders rather than benefiting Australian communities. The grocery market in Australia has become a case study in market failure. 5 players control over 80% of all grocery sales, with 2 players alone controlling 67%. Competition is limited, prices are high, suppliers are squeezed mercilessly, and consumers have no realistic alternatives. The major players are either foreign-owned, ALDI, Costco, Amazon, or Australian companies with substantial foreign ownership and profit extraction, Woolworths, Coles. The independent grocers who once provided community-based alternatives have been systematically eliminated or marginalized to the point of irrelevance. The local butcher, baker, and grocer who once served neighborhoods have been replaced by corporate giants that maximize efficiency and extract profits. The sense of community and local connection that came with neighborhood shops has been lost to the economics of scale and market domination. The future looks bleak for competition and choice in Australian grocery retail. The ACCC's report makes clear there is no easy solution, no silver bullet that will restore genuine competition. Woolworths and Coles have built empires that appear unassailable, with advantages so significant that challenging them seems nearly impossible.